The value of 1 crore invested in 2000 is now 18 crores. So it has compounded at 14% for 23 years. This is in spite of the big crashes of 26%, 23%, 32 and 38%. Each crash is followed by a big bull run that outweighs the previous correction. So for wealth creation, bear the corrections and look beyond short-term volatility. If the market has given 14% annualized, then we may wonder, why doesn't it just grow 14% every year? Why the crashes? Howard Marks, in his book Mastering Market Cycles, talks about this. It happens because humans have emotion. We always act in extremes. When the going is good, investors are more optimistic and aggressive. And if there is too much money in the system, it creates a situation of excess. Price rises beyond the true value, not due to good events, but due to human psychology of how we perceive the good events. Kindleberg said there is nothing more disturbing than watching a friend get rich. This leads to fear of missing out, replacing the fear of losing. This is the time for caution. But investors are unable to be cautious since high prices correspond to high in emotion. Mostly we find making investments at this time leading to poor returns or losses. The moment you invest, you typically see there is a 10 to 20% loss because we typically invest at these times. As realization hits, fear takes over and we become more risk averse. Psychology becomes weaker. As psychology worsens, more investors sell, driving prices even lower. Lower the prices go, more people are now compelled to sell. This takes away all the excesses. The movement down is very fast and scary. The stock prices are low. The prospective returns are high here. This is the time to be aggressive in the market. But investors are terrified as lower prices correspond to low psychology. This is human nature and it will never change. Mark Twain said, these things will happen again and again and cycles will repeat. Length, the amplitude and the reason for cycles change each time. Understanding the cycles is what is required to be a successful investor. Knowing where we stand in the cycle, knowing the odds of success can deliver the greatest advantages in investing. Someone gets famous every now and then, predicting the market correctly. It is usually luck. So they usually get it right just once. Almost no one is right more than once in a row. If you look at the greatest investors of all times, no one ever got rich by predicting the future. Difficulty in making predictions is due to the big influence of randomness. Most likely things to happen do not happen. Things we thought are impossible to happen suddenly happen. As Howard Marks explains, these were the two things considered very certain in America. Hillary Clinton will be elected a president. And if by chance Trump wins, the markets would collapse. But Trump won and the markets went up. This settles the matter. We do not know what the future holds. Instead of focusing on the macro future, which is not in our control, we focus on analyzing and researching companies, stocks, and the industry. With mutual fund, we outsource this to a professional fund management team. Second is to act and behave in a countercyclical manner. We do not know what lies ahead in the future, but we can know where we are today, and hence based on that, we can decide either to be very aggressive in our approach or very conservative. Investing trouble is not because we are not able to forecast the future, but the inability to manage emotions in the present. Our emotions swing cyclically rather than countercyclically. There are 3 stages in a bull market. First, when a few exceptional people, bright, understand that there can be improvements. Most people do not believe that the future is good. There is very little optimism, therefore prices are very cheap, but the interest is very low. You actually make a good money if you're investing here. In the second stage, most people understand that the improvements are likely to take place or are taking place. Therefore, stock prices are not available at a bargain. You buy at fair price, and in the third stage, there is very little chance of you making any money. You invariably make a loss. So it is about when you buy, not which fund you buy. As Vijay Kedia puts it, in the market, there is a time to be active, time to be selective, and a time to be inactive in the market. Inactivity is also an activity. Please consider liking and sharing it with your friends.